A pair of frames costs $4 to make, sometimes $8 if the plastic is good. The lenses inside them cost about $1.25. Put them together, ship them across an ocean, and a company can sell that same pair of glasses to you for $800. That is not a rumor. That is not an exaggeration for a thumbnail. That is a number a man who built one of America's biggest optical chains gave to the Los Angeles Times after walking through the factories himself. And here is the part that should stop you cold. Almost every brand competing for your money on that store wall is owned by the same company. Ray-Ban, Oakley, Purcell, Oliver Peoples. The lens in your prescription, the insurance plan that decided which store you'd shop at in the first place. One company, one price floor, one empire built on a $4 frame. In 2026, that empire lost more than $70 billion in market value in under 8 months. Something broke. Somewhere in the last 12 months, the story eyewear companies have been telling the public for half a century stopped adding up in front of investors, in front of federal courts, and in front of anyone willing to do the math on a receipt. And the break started in a set of factory towns in eastern China that most Americans have never heard of and could not find on a map. This isn't speculation dressed up as a documentary. The company at the center of this is EssilorLuxottica, a real publicly traded Franco-Italian giant listed on the Euronext Paris exchange, formed in 2018 when Luxottica, the frame maker, merged with Essilor, the world's largest lens manufacturer, in a deal worth $58 billion. E. Dean Butler, who founded LensCrafters in 1983 and built it into North America's largest optical chain before losing control of the company he started, went back to see the industry he'd helped build. He toured the Chinese factories firsthand in 2019. What he found? He told the Los Angeles Times bluntly, "It's a complete ripoff." Charles Dahan, who ran Custom Optical and once supplied 20% of LensCrafters' inventory, backed him up. Columbia Law professor Tim Wu, who served as a White House antitrust advisor under 2 administrations, has called the company's profit margins relatively obscene. This is not fringe commentary. This is testimony from people who spent their careers inside this exact industry, on the inside of the exact supply chain we're about to walk through. And it isn't just the frame makers saying it. A 2023 federal antitrust complaint, later consolidated in the Southern District of New York, laid out the same arithmetic in legal language. Lenses manufactured for roughly $5 a pair, sold at retail for well over $100. The filing didn't come from a disgruntled blogger. It came from licensed attorneys building a case meant to survive a motion to dismiss in front of a sitting federal judge. Whatever you make of where this story ends up, the starting numbers are not in dispute. Everyone involved, the plaintiffs, the defendants, and the industry veterans who used to run these companies, agrees on what a frame costs to build. The argument is only ever about what happens to the price after that. Think of it like this. Imagine one company owned the wheat farm, the flour mill, the bakery, and the only grocery store in town, and then charged you gold bar prices for a loaf of bread, while telling you that you had dozens of bakeries to choose from. That's the eyewear industry. EssilorLuxottica doesn't just make glasses. It makes the lenses, owns the frame brands, runs the retail stores that sell them, and through its iMed subsidiary, even touches the vision insurance that quietly steers patients toward its own shelves. And here's the number worth sitting with twice. At its peak in November of 2025, this single company controlled roughly 80% of the branded global eyewear market and carried a valuation north of $160 billion. Picture that against something you already understand. That's larger than the market cap of Ford and General Motors combined, for a company that, at its core, sells you plastic and curved glass. Put it a second way, too. $160 billion is roughly what it would cost to buy every home in a mid-sized American state, all at once, in cash. That's the size of the empire sitting on top of a $4 frame. Now picture the other side of that equation, because this is where the real story begins. Roughly 90% of the world's eyeglass frames are manufactured in China, not assembled there. Designed, molded, polished, and boxed there. Wenzhou, in Zhejiang province, is home to more than 1,000 eyewear manufacturers and has been building frames since the 1990s. Yiwu, famous worldwide for its wholesale markets, complements it with volume and variety. Shenzhen's Hengang district has become such a hub for eyewear that locals call it the city's optical business card. But the real epicenter is a smaller city most people outside the industry have never said out loud, Danyang in Jiangsu province. There's a saying inside the trade, 1 out of every 2 people on Earth who wears glasses is wearing lenses that came out of Danyang. The city produces roughly 400 million lenses a year, close to half of the entire world's resin lens supply. Step off the train there and you're greeted by the Danyang International Optical Center, the largest eyewear trading market anywhere on the planet. This is not a black market operation or a knockoff district. Suppliers there routinely carry ISO 9001 quality certifications, CE marks for the European market, and FDA compliance documentation for shipments into the United States. These are audited, legitimate industrial operations, some employing hundreds of workers under a single roof, with export histories running into the hundreds of thousands of dollars a year. This is the literal physical foundation the $800 retail price sits on top of, and it has been sitting there, mostly unnoticed, for 3 decades. What's easy to miss is that EssilorLuxottica itself is deeply embedded in this same geography. The company opened its first Chinese manufacturing site back in 1997 and has expanded its footprint there ever since, through its own factories and through acquisitions like Oakley in 2007. In other words, the company selling you an $800 pair of Ray-Bans and the factory selling a nearly identical frame for $8 are, in a meaningful number of cases, standing in the same industrial park. The difference was never really about where the glasses were made. It was about who. Here's where it gets interesting, because for decades, that foundation stayed invisible to the American consumer. You walked into a mall, picked a frame off the wall, and had no idea it likely came out of the same factory cluster, whether you paid $40 or $400. The company selling it to you controlled every link in the chain between the factory and your face, and controlled the story you were told about why it cost what it cost. Then, starting quietly in the early 2000s and accelerating hard in the last few years, a handful of companies decided to cut out every link except the first and the last. Zenni Optical, founded in 2003 and headquartered in Novato, California, builds its own frames directly out of a factory in Danyang and sells them straight to consumers online. No store, no insurance middleman, no name brand markup. Complete prescription glasses start at $6.95. The company now ships roughly 7,000 pairs of prescription eyewear every single day to more than 80 countries. That is not a coupon gimmick. That is a fundamentally different supply chain, 1 link long instead of 5, and it undercuts the traditional model, not by a little, but by a factor of over 100. Zenni isn't alone either. Warby Parker built an entire consumer brand around the same basic promise of skipping the traditional retail markup, even though it now manufactures at a higher price point and has grown into a public company with its own retail footprint. Independent opticians who source frames directly from Wenzhou and Shenzhen suppliers, rather than through licensed distributors, have quietly multiplied across online marketplaces. And Chinese cross-border e-commerce platforms have made it trivial for an ordinary shopper anywhere in the world to order frames straight from the same factory clusters that used to sell exclusively to the big brands. No distributor, no retail lease, no insurance network required. None of this happened overnight. It happened factory order by factory order over roughly 2 decades until it reached a scale too large for the traditional model to simply outmarket. Let's pause and restack what we've covered, because the pieces matter. One company controls roughly 80% of the branded eyewear you see in stores, manufactures almost none of it in-house without leaning on the exact same Chinese factory regions everyone else uses, and was, until very recently, worth more than $160 billion on the strength of that arrangement. Meanwhile, the raw manufacturing base underneath the entire global industry, frames costing $4 to $8, lenses costing about $1.25, sits almost entirely inside a few Chinese provinces. And increasingly, companies are building direct pipelines from those factories straight to your mailbox. That single shift, cutting the retail chain down to 1 link, is quietly doing to eyewear what discount airlines once did to transatlantic flights, and what direct-to-consumer mattress startups once did to furniture showrooms, proving that a familiar, trusted-looking markup can survive for decades, right up until someone shows the customer the receipt underneath it. Now here's the part that connects everything. 2026 is the year this quiet tension turned into a very public reckoning, one that showed up not in a press release, but on a stock ticker. In the next part of this, we follow the money, starting with the single sharpest 12-month stretch this company has had since the 2018 merger that created it. EssilorLuxottica's shares hit an all-time high in mid-November 2025, trading north of 370 euros, pushing the company's market capitalization above $160 billion. By mid-August 2026, the US-listed shares had fallen more than 40% from where they started the year, and the market cap had been cut down to somewhere around $87 to $92 billion. That is not a dip. That is tens of billions of dollars evaporating in roughly 9 months from a company that, by its own numbers, was still growing its underlying revenue the entire time. In the first quarter of 2026 alone, EssilorLuxottica reported revenue up 10.8% at constant exchange rates. Sales were not the problem. The market had stopped believing in the story. Analysts covering the stock even flagged a strange contradiction sitting inside the numbers themselves. By mid-August 2026, one valuation model priced the shares at more than 40% above their calculated intrinsic worth, even after the crash, while the actual share price kept drifting lower. In plain terms, some of the same people crunching the numbers couldn't fully explain how far the stock had fallen given what the underlying business was still earning. That gap between the math and the mood is usually the clearest sign that a story, not a spreadsheet, is driving a stock. Part of what cracked that story is the direct pressure we've already laid out. The reality that the company's entire pricing model depends on consumers not looking too closely at where their $4 frames actually come from, at a moment when factory direct competitors are making that origin impossible to ignore. But there's a second front, and to tell this honestly, it needs its own space. In 2023, a sweeping antitrust class action was filed in federal court, naming EssilorLuxottica and 48 co-defendants, including Prada, Chanel, Burberry, Tiffany, and Ralph Lauren, accusing them of conspiring to inflate eyewear prices by as much as 1,000%. The case, formally titled In Re Eyewear Antitrust Litigation, argued the company used its iMed insurance subsidiary to funnel patients toward its own overpriced shelves. EssilorLuxottica's own lawyers countered that building a successful company over many decades is unlawful. That is not an antitrust violation. It is good business. In September 2025, a federal judge largely agreed with the company, dismissing the core claims for failing to properly define the relevant market. The buyers were left one narrow path to refile. The legal system, at least so far, has not called this company a monopoly in the eyes of the law. A related complaint, still working its way through the courts as of 2026, names dozens of brands most consumers assumed were independent competitors, but among them Tory Burch, Bulgari, Prada, Chanel, and Christian Dior, and alleges the group used the iMed Vision Benefits subsidiary to financially incentivize eye doctors into steering patients toward its own shelves. Whatever the final outcome, the sheer size of that defendant list tells its own story about how consolidated this industry actually became. The public narrative and the pricing arithmetic underneath it tells a different story than the courtroom has ruled on so far. And both versions matter here. Now here's the part that most coverage of this story leaves out entirely, and it's the part that actually explains most of that stock collapse. Bernstein, the research firm that tracks EssilorLuxottica closely, called the emergence of AI-powered smart glasses a fundamental threat to the company's entire business model. Not because of cheap Chinese sunglasses, but because Apple, Google, Samsung, and Meta are racing to build a completely new eyewear supply chain. From scratch, one EssilorLuxottica doesn't control the way it controls the traditional frame business. EssilorLuxottica's own partnership with Meta on Ray-Ban AI glasses had been a genuine bright spot, with more than 7 million units sold in 2025 alone. But that same wearables push came with a cost. Adjusted operating margins slid to around 16%, well short of the 19 to 20% target management had promised investors for the end of 2026, when the company quietly swapped that specific target for a vaguer 5-year framework. Confidence didn't just wobble, it broke. Add in U.S. tariffs, a weaker dollar, and geopolitical noise rattling every part of the luxury sector that quarter, and you get a stock that fell even while the underlying company kept growing sales. So which is it? A 5-decade-old monopoly finally undone by $4 Chinese frames, or a smart glasses gamble that spooked Wall Street? The honest answer is that it's both, tangled together in a way that's easy to flatten into a single dramatic headline, but harder to actually untangle. The factory direct disruption from places like Danyang and companies like Zenni represents the slow, burning structural threat, proof that the retail markup this entire empire depends on can be bypassed, one order at a time. The smart glasses margin story represents the sharp, sudden threat, the fear that the next era of eyewear won't be won on frames and lenses at all, but on chips, cameras, and AI, a fight EssilorLuxottica is only now trying to enter on equal footing, including a new joint. Development agreement with Applied Materials to build next-generation AR optics from a lab on Applied Materials-owned Silicon Valley campus. Kepler Chevreux, another major research firm tracking the stock, put it plainly, with growth guidance implying more than 13% expansion in the coming quarters. Execution now hinges on the success of new smart glasses models against tougher year-over-year comparisons and a field of competitors with far deeper pockets in silicon and software than in eyewear. Reuters reported the stock as the single biggest faller on the entire French blue chip index on more than one session in 2026, a strange fate for a company that, on paper, was still one of the most dominant players in its own market. To be clear about what is not settled here, because a fair count has to include this, EssilorLuxottica has not lost its market position. It still owns roughly 80% of the branded eyewear market, still controls Ray-Ban, Oakley, LensCrafters, and Sunglass Hut, and its CEO, Francesco Milleri, has publicly expressed confidence in a share price recovery, pointing to a longer-term push into the medical technology side of vision care. Analysts at Bernstein, even while flagging the smart glasses threat, maintained a market perform rating rather than a sell. Nobody serious is claiming the traditional eyewear giant is finished, or that Chinese factories are about to put LensCrafters out of business next year. It's also worth being honest about scale. Zenni, for all its growth, still ships a tiny fraction of the volume EssilorLuxottica moves through its thousands of retail stores worldwide, and most American shoppers still walk into a mall and buy from a familiar brand name without ever comparing it to a factory direct alternative online. Disruption at the edges of a market is not the same thing as the collapse of that market, and conflating the two is exactly the kind of oversimplification a fair account of this story has to resist. What has genuinely changed is confidence, valuation, and the once unquestioned assumption that this company's grip on the industry was permanent. A $160 billion company does not need to collapse to zero for its story to change. It just needs the market to stop. Believing the moat is as wide as it used to be. That has already happened, whether the retail shelves show it yet or not. There is something almost poetic about how this closes the loop. It started with a $4 frame in a factory most people will never visit, made by workers most people will never meet, in a city, Danyang, that quietly supplies lenses to nearly half the planet. Without most of the planet knowing its name, it ends for now with one of the largest and oldest consumer monopolies in the modern world, watching tens of billions of dollars drain out of its valuation in less than a year, caught between the cheap, invisible supply chain it always depended on, and a new technological race it doesn't yet fully control. Whether that ending is temporary or permanent is something neither the stock market nor the federal courts have finished deciding. What's already certain is that the arrangement holding the old price tag together, the $4 frame quietly marked up 200 times before it reached your face, is no longer invisible. Once a system like that gets seen clearly by regulators, by competitors, and by the ordinary person comparing two receipts, it rarely goes back to being invisible again. The $800 price tag was never really about the plastic or the glass. It was about how long people were willing to not ask where either one came from. That question is finally being asked loudly by factories, by lawyers, and now by the stock market itself. So tell us in the comments, which number shocked you more? The $4 it actually costs to make the frames you're wearing right now, or the more than $70 billion in value this single company has lost in under a year? And subscribe if you want the next chapter of this story, because the smart glasses race that's rattling this monopoly right now is only just getting started.